Imagine waking up tomorrow and seeing the Dow Jones, Nasdaq, and S&P 500 all crashing, not because of weak earnings, but because a war thousands of miles away is shaking the very foundations of your retirement, your savings, and the price of gas at your local pump. Missile strikes, energy choke points, and geopolitical chaos are no longer just headlines. They are real, immediate threats to your money and daily life. In the next few minutes, we're breaking down exactly how this Middle East conflict is driving fear, volatility, and inflation straight into the U.S. economy, and why every investor, worker, and consumer needs to understand what's happening before it hits your wallet.
The ongoing 2026 Middle East conflict between the United States, Israel, and Iran has done more than dominate geopolitical headlines. It has reshaped investor behavior and sent U.S. stock markets into an abrupt correction, a reality that traders, retirees, and everyday Americans are feeling daily. What began with targeted airstrikes against Iranian strategic assets escalated into broader military exchanges, including Iranian missile and drone responses directed at U.S. bases and allied territories. And this has heightened fears of supply chain disruptions and prolonged geopolitical instability. In financial terms, this is translated into a clear flight to safety market dynamic. The Dow Jones Industrial Average, the Nasdaq Composite, and the S&P 500 have all fallen sharply, with the Dow officially entering correction territory, defined as a decline of more than 10% from recent peaks, marking their worst stretch of losses in months and confirming broader weakness across equity markets. Rather than reacting to weak earnings or domestic economic shocks, investors are selling risk assets because uncertainty about the conflict's trajectory and its economic consequences now overshadows corporate fundamentals. This pattern of market behavior fits classic financial theory. When faced with rising geopolitical risk, investors reassess expected returns and demand a higher risk premium to hold equities, meaning stock prices must fall unless future profits are revised upward, which is unlikely in a war-impacted environment, from the largest mega-cap tech companies to broad consumer discretionary stocks. Sectors that typically thrive in calm economic conditions have taken heavy losses as risk appetite wanes. In contrast, safe haven assets such as U.S. Treasury bonds, government-backed securities, and precious metals like gold have experienced strong demand, highlighting a classic risk-off rotation where capital flows out of equities and into perceived security. Even currencies deemed safe, like the US dollar, have strengthened as global investors seek stability amid chaos. A significant driver of this market correction has been the sharp rise in oil and energy prices linked directly to the conflict's impact on key shipping lanes, especially the Strait of Hormuz, a choke point through which nearly 1/5 of global crude oil trade and a quarter of oil shipped by sea normally passes. Iran's threats to restrict passage after joint U.S. and Israeli military operations, combined with actual disruptions to shipping traffic, have stoked fears of broader or sustained supply interruptions, pushing U.S. crude prices near or above $99 100 per barrel in international benchmarks like Brent above $110. Higher energy prices don't just affect gasoline at the pump. They ripple throughout all sectors of the economy. Transportation costs rise, production becomes more expensive for manufacturers, agriculture faces increased fuel and fertilizer costs, and input prices filter through consumer goods. As a result, inflation expectations, which policymakers and investors alike were hoping had cooled after tough years of post-pandemic tightening, have once again come under pressure. The inflation threat complicates the Federal Reserve's policy roadmap. Prior to the conflict, there was growing market speculation that inflation was moderating enough to justify rate cuts, or at least a pause in tightening. Now, with energy prices climbing and inflation risk reemerging, markets are pricing in the likelihood of higher interest rates for longer, even as economic growth slows. Higher borrowing costs, reflected in rising yields on long-term government bonds, reduce the valuation appeal of stocks, particularly those with earnings projected further into the future, while also squeezing consumer spending and business investment. This intersection of war-driven cost shocks and monetary policy uncertainty has amplified the correction, turning what might have been a short-lived dip into something more pronounced and potentially longer-lasting. On the psychological side, modern financial markets are deeply sensitive to fear and uncertainty, often more so than to hard economic data. Research and historical patterns consistently show that markets price uncertainty, not just conflict itself. When investors cannot reliably forecast future cash flows, trade conditions, or policy responses, they demand higher compensation for holding riskier assets. In the current environment, media coverage emphasizing potential blockades, shipping disruptions, and fluctuating energy prices has fed this anxiety, triggering rapid de-risking across portfolios worldwide. Institutional investors, algorithmic trading systems, and retail participants alike are responding to this uncertainty by reducing equity exposure, which in turn pushes index levels lower, a self-reinforcing feedback loop until clarity returns or risk perceptions stabilize. The effects of this correction are not confined to Wall Street trading floors. Retirement accounts, pension funds, and mutual funds held by millions of Americans are directly affected as valuations fall, reducing net worth and long-term retirement projections. Consumer confidence, already fragile from inflation and high living costs, has further eroded as households witness market losses and brace for tighter credit conditions. Surveys show sentiment dropping notably, reflecting broader unease about job security, household finances, and general economic prospects in the shadow of conflict-driven uncertainty. Corporate behavior is also shifting. Executives are delaying hiring or capital expenditure decisions until volatility subsides, and some industries, especially those linked to travel, leisure, and durable goods, are seeing demand slow as consumers prioritize essentials amid higher fuel and commodity prices. Global capital markets have felt these war-induced shocks as well. Major equity indices in Europe and Asia have also declined, and emerging markets have faced currency pressures as funds move toward U.S. assets perceived as safer. Gold prices have risen as investors hedge against both inflation and market risk, while safe bonds draw capital despite low returns. Even the petrodollar system, long a cornerstone of global oil trade, denominated in U.S. dollars, is being questioned. With Gulf nations exploring non-dollar trading arrangements and diversifying reserves in response to regional instability and growing geopolitical uncertainty. This far-reaching response underscores one of the core economic realities of modern conflict. Distant wars can quickly become global economic events with broad consequences for trade, investment flows, and currency markets. In practical terms, the Dow, S&P 500, and NASDAQ declines reflect the global risk-off sentiment, where investors essentially price in fear. Not because companies are failing, but because the future has become harder to predict, and because the stakes of geopolitical escalation include energy security, international commerce, and national economic outcomes. This explains why the sell-off has been broad and sustained rather than isolated to specific sectors. Uncertainty affects nearly all aspects of financial decision-making. While some industries, such as energy and defense, may benefit temporarily from rising prices or increased government spending, the broader equity market tends to react negatively when conflict disrupts expected economic conditions. Ultimately, the 2026 Middle East war shows how interconnected the modern global economy has become. A conflict thousands of miles away can influence energy prices, investor psychology, interest rates, consumer behavior, and market valuations in the United States. Whether markets rebound rapidly once the conflict stabilizes, or whether this correction persists longer, depends on diplomatic outcomes, energy supply normalization, and central bank responses in the coming weeks and months. But for now, the downturn vividly illustrates how war can translate into direct economic consequences, reshaping financial reality at home even as the conflict continues abroad. The ongoing 2026 Middle East war has sent shockwaves not only through U.S. financial markets, but also through the energy sector, dramatically amplifying inflation fears that have been simmering since the post-pandemic recovery and subsequent supply chain disruptions. As hostilities escalate between the U.S., Israel, and Iran, concerns over the Strait of Hormuz, one of the world's most critical oil choke points, have taken center stage, with investors, energy traders, and policymakers alike fearing significant interruptions to global crude supply. The mere threat of a blockade or missile attacks on shipping routes has caused U.S. crude oil prices to surge sharply, with West Texas Intermediate, WTI, and Brent crude benchmark futures both spiking by double-digit percentages within days. These sudden price jumps reverberate across nearly every sector of the economy. Transportation costs rise, affecting airlines, trucking, and shipping. Manufacturing expenses escalate as energy-intensive industries struggle with higher input costs. And agricultural production suffers with fertilizers, irrigation, and machinery fuel expenses climbing in tandem. The immediate effect is a direct squeeze on corporate margins, as businesses face the choice of absorbing costs or passing them on to consumers, with many opting for the latter, which amplifies consumer price inflation and triggers widespread concern among households already grappling with rising grocery, housing, and energy bills. In this volatile environment, the Federal Reserve faces a uniquely challenging policy dilemma: raising interest rates to combat inflation risks, slowing an already fragile economy, potentially tipping sectors such as housing, auto, and discretionary spending into contraction, whereas pausing or cutting rates could further fuel inflation, undermining consumer purchasing power and long-term price stability. This delicate balance is compounded by the uncertainty surrounding the conflict's duration and scale, with analysts warning that even a temporary escalation can set off cascading effects across global trade networks. Stock markets have reacted accordingly, with equities and energy-sensitive sectors fluctuating wildly, while defensive sectors such as utilities and consumer staples attract flight-to-safety capital. Fixed income markets have also felt the tremors. Treasury yields are rising in response to inflation expectations, yet investors continue to seek the relative safety of government bonds, creating unusual volatility patterns that confuse even seasoned traders. Portfolio managers are increasingly rotating holdings between equities, bonds, commodities, and currencies, aiming to hedge against risk, while algorithms automatically adjust positions in milliseconds, magnifying intraday swings. The feedback loop of energy-driven inflation has thus become clear. Higher crude prices lead to higher corporate and consumer costs, which pressure central bank decisions, which then feed back into market valuations, further fueling uncertainty and volatility. The war's influence on consumer behavior and corporate strategy cannot be overstated. Households observing both rising gas prices and shrinking stock portfolios are becoming more cautious, curtailing discretionary spending on non-essential items, delaying large purchases, and favoring savings. This slowdown in consumption directly affects manufacturers, retailers, and service providers, who in turn defer hiring, reduce overtime, or delay capital expenditure, compounding the economic drag. Retail analysts report flattening sales growth and increased inventory, holding in anticipation of further price shocks, while supply chain managers struggle to source energy-dependent inputs amid regional uncertainty. Agricultural producers, reliant on stable fuel and fertilizer supply, face delayed planning schedules and higher operational costs, which could eventually push food prices even higher, feeding a cycle of inflationary pressure that touches all Americans, from the urban commuter to the rural farmer. Financial markets, already jittery from geopolitical uncertainty, are now pricing in scenario-based risk assessments that anticipate multiple conflict outcomes. Traders are using futures, options, and hedging instruments to manage exposure, leading to higher volatility indexes, VIX, and wider bid-ask spreads across energy and equity markets. The elevated energy-driven inflation is causing synchronized movements across asset classes. As crude surges, oil company equities spike, while airlines, logistics, and energy importing sectors fall. Simultaneously, commodities like gold and silver gain attention as hedges, and treasury bonds oscillate between yield-driven attraction and inflation-adjusted caution. This multi-asset impact underscores a critical lesson for investors and policymakers alike. Regional conflicts can generate immediate, cross-sector economic ripples that are both deep and wide, influencing decisions from corporate boardrooms to Main Street households. Moreover, the psychology of inflation during a conflict exacerbates market reactions. Investors are not merely responding to data, but to fear of future scarcity and escalating prices, which encourages preemptive action, such as portfolio rebalancing, speculative commodity purchases, and accelerated cash hoarding. This behavior feeds a self-reinforcing inflation narrative, where expectations of higher prices today make both corporations and consumers more likely to spend or adjust now rather than later, effectively accelerating inflationary dynamics. Analysts highlight that this war-driven inflation differs from typical cyclical price rises. It is exogenously driven by geopolitical risk rather than domestic demand shocks, meaning traditional monetary levers may be less immediately effective. And central banks must weigh global implications alongside domestic policy mandates. In essence, Chapter 2 captures how the Middle East conflict has transformed energy markets into both an economic shock vector and a psychological catalyst, producing an environment where every rise in crude oil prices has far-reaching implications across sectors, from transportation and manufacturing to agriculture and consumer spending. U.S. businesses are navigating higher input costs and uncertain growth prospects. Consumers are tightening budgets in response to inflationary pressures, and financial markets are oscillating between fear and opportunity in response to rapidly changing global conditions. The Federal Reserve's challenge of balancing rate policy against economic growth, inflation expectations, and geopolitical uncertainty illustrates the complex interplay of macroeconomic policy and market sentiment, highlighting how a regional conflict can evolve into a full-fledged economic event with both immediate and long-term consequences. As such, the chapter underscores the vital need for strategic monitoring, adaptive investment strategies, and public awareness, offering a clear view of how war in one region can ripple through global financial, consumer, and policy landscapes almost instantaneously, demonstrating the modern interconnectedness of geopolitics and economics in the United States. The ongoing 2026 Middle East war has not only rattled markets through tangible economic disruptions, like rising oil prices and supply chain risks, but it has also profoundly reshaped investor psychology, turning fear and uncertainty into dominant forces driving market behavior. Unlike corrections driven purely by weak fundamentals or earnings misses, this conflict has injected a sense of unpredictability into global markets, magnifying volatility and reinforcing a broad risk-off sentiment among investors of all types, from institutional hedge funds to retail participants managing retirement portfolios. Historical market patterns suggest that initial overreactions to geopolitical events are common, often producing sharp, abrupt declines, followed by partial recoveries. However, this conflict's direct threat to critical energy supply chains, international shipping routes, and regional stability implies that uncertainty is likely to persist longer than in typical market shocks. Analysts note that such sustained geopolitical tension can lead to a series of compounding effects. Corporations may delay hiring and capital expenditure decisions, consumers may curtail discretionary spending, and financial institutions may recalibrate risk models, all of which feed back into market dynamics in a self-reinforcing loop of caution and volatility. The current environment demonstrates how modern markets are deeply sensitive, not just to real economic outcomes, but to perceptions and expectations about potential scenarios, creating a situation where investor sentiment often overrides fundamental analysis. In practice, this has led to sector-specific divergences. Energy and defense-related equities have risen in anticipation of higher demand and government spending, while technology, travel, and consumer discretionary sectors have faced sharp declines as investors reprice risk and reduce exposure to highly cyclical or growth-dependent businesses. Safe haven assets, including gold, silver, U.S. treasuries, and select stable currencies, have simultaneously experienced inflows, reflecting a classic flight to safety response. Portfolio managers are increasingly adopting dynamic hedging strategies, reallocating funds to mitigate geopolitical and energy-related risks, while algorithmic trading systems amplify these moves, generating intraday swings that can exaggerate market reactions beyond what would be expected from fundamentals alone. In essence, the war has converted market narratives from purely financial considerations into geopolitical ones, making investor decisions acutely sensitive to developments thousands of miles away. The broader macroeconomic implications are significant. Inflation expectations, already heightened by energy price shocks, are now intertwined with market sentiment. Even if core economic indicators remain stable, the psychological impact of uncertainty is prompting preemptive action, including accelerated purchases of commodities, reduction of leverage, and reallocation from equities to fixed income or alternative assets. Central banks, including the Federal Reserve, are caught in a delicate balancing act, attempting to calibrate interest rate policy to tame inflation without stifling growth amid unpredictable global conditions. The interplay of rising energy costs, shifting investor sentiment, and cautious corporate behavior creates a scenario where traditional monetary tools may be less immediately effective, amplifying the importance of investor perception and media narratives in shaping market outcomes. From a global perspective, the U.S. market is now deeply interconnected with international capital flows. Investors worldwide are reacting not only to domestic implications, but also to the potential for global contagion. Disruptions to energy supply, trade slowdowns, and heightened geopolitical tensions could impact emerging markets, currency stability, and cross-border investment portfolios. This interconnectedness has magnified the stakes as declines in U.S. indices ripple abroad, triggering synchronized risk-off movements in equities, bonds, and commodities worldwide. Furthermore, the war is influencing corporate and investor strategy beyond immediate market transactions. Companies are reconsidering supply chain vulnerabilities, exploring energy diversification, and adjusting long-term investment plans, while individual investors are increasingly mindful of geopolitical risk when making everyday economic decisions, from stock purchases to retirement planning. The uncertainty has also created fertile ground for behavioral economic phenomena, such as herd behavior, overreaction to news cycles, and amplified volatility due to algorithmic trading. Investors often react to incomplete information or worst-case scenario projections, which in turn generates price swings and reinforces the perception of risk. In a feedback loop, media coverage emphasizing potential escalation, missile strikes, and strategic choke points in energy supply magnifies investor concern, resulting in preemptive portfolio adjustments that further drive market volatility. These dynamics underscore a key lesson of modern financial markets. In times of geopolitical crisis, market psychology can be as powerful a driver as economic fundamentals, with everyday financial decisions, from corporate investments to personal consumption, becoming directly linked to distant conflicts. Looking forward, there are multiple potential outcomes, each with distinct economic and market implications. If tensions ease rapidly and supply disruptions are contained, markets may experience a short-lived correction, with risk appetite gradually returning and equities recovering some lost ground. However, if the war continues or escalates, volatility is likely to persist, with structural shifts in investor behavior, hedging strategies, and global supply chains. Corporations may adopt more conservative investment postures, consumers may continue cautious spending, and financial markets could remain sensitive to even minor developments in the conflict. Strategic planning will require continuous monitoring of both geopolitical and economic indicators, emphasizing the increasingly blurred lines between financial market analysis and international affairs. In summary, the 2026 Middle East war has transformed the U.S. financial landscape by embedding fear, uncertainty, and geopolitical risk into the very fabric of market operations. The interplay of energy supply threats, inflationary pressures, corporate caution, and investor psychology has created a volatile environment in which market movements are dictated as much by perception as by fundamentals. Everyday economic decisions, from equity investments to consumption choices, are now inextricably tied to the trajectory of the conflict, demonstrating the profound and immediate impact a regional war can have on the global economy. Chapter 3 illustrates that in today's interconnected markets, geopolitics is not just a backdrop, but a central driver of financial narratives, with implications for both institutional and individual actors, highlighting the importance of strategic awareness, adaptive risk management, and informed decision-making in navigating an era where distant conflicts can directly shape economic reality in the United States and beyond. Subscribe my channel for more videos.